Okay, here's the multi-million-dollar question. We were talking about 2021, but most of us are in this for the long haul. We're buy and hold investors. So do you see these kind of dynamics continuing over the next 3 to 5 years?
I can't imagine that at some point we don't get caught up from a supply and demand perspective. So no, I don't think we'll continue to see the huge imbalance in supply and demand. I think this is a perfect storm. We have a cohort that's aging into prime homeownership years in large numbers, and historically low interest rates driving demand at precisely the same time that people are pulling their properties off the market. And the builders are in drastic catch-up mode. So no, I think the other thing we didn't talk about, this is kind of inside baseball stuff, is that the other end of the age group, the boomers, which prior to the millennials were the largest age cohort, have largely decided to age in place. And so the average time a person spends in a home has gone from between 5 and 7 years, 10 years ago, to almost 12 years today.
Wow.
So they're not moving they're and again, right now, if you were an aging boomer, would you want to go into a nursing home? Not so much.
No.
So we've seen a lot of boomers, either because family members are moving in, their adult children, their aging parents, they've stayed in place, and eventually some of those properties are going to come to market as well. So combination of pandemic going away, people listing their homes, boomers eventually downsizing, builders finally catching up, changes that supply-demand imbalance. Plus, Gen Z isn't quite as big as millennials, and that's the next cohort. So that demand capacity should go down a little bit. So I think by the time you're 2024, 2025, you should see something resembling more of a normal market. The other factor we have to keep in mind is that the global economy has taken a huge hit over the last 9 months, a lot of shock to the system. There are fiscal policies right now, economic policies right now that could have repercussions 3, 4, 5 years down the road. We could see all this money we're printing today turn into inflation in a few years. So that interest rate on your mortgage could go from 2.5% to 6.5% before you blink. So there are other factors to keep an eye on that could have a definite impact on what goes on in housing.
And again, inflation is good if you own the asset. It's not so good if you don't.
Correct. Exactly correct.
Kind of leads me to this next question of how should we be preparing for the opportunities ahead? I think this person is still thinking that there would be a lot of foreclosures coming, and I don't know that. I mean, there will be more, right? But you better be pretty darn good at getting them because you've got to compete with iBuyers now.
Yeah, and that's a great point, Kathy. There was a lot of chatter about the big institutions coming in and buying properties to rent out back in 2009 when we were in the middle of a real foreclosure crisis. And for all of the discussion about, Blackstone and American Homes for Rent and all the other big buyers, they still account for less than 2% of all the single family homes that are being rented. Now, Opendoor just went public last week, multi-billion-dollar valuation. Zillow is buying properties, OfferPads is buying properties. There will probably be some other maybe regional iBuyers pop up into the market, and their value proposition for a distressed seller is perfect. It's you got to sell a property quickly, and you have to get an absolute guarantee that the sale is going to go through, and that's their value proposition. Now, for most home sellers today, that's meaningless because you're going to sell your property in 7 days, and you have multiple bidders bidding on it, so you're going to get the highest possible price. But you guys will be competing with the iBuyers. There are things you might have at your disposal, and I don't know if this is a RealWealth Network tactic or something you advise against, but in some cases, you might be able to offer that home seller the opportunity to rent the property back from you, which an iBuyer typically will not do because they're looking to buy and flip. You could give them extended terms to get out of the property before you take it over as a rental unit. So there are things you can do working with those sellers in kind of a local market relationship that an Opendoor or Zillow offers really won't be able to do or won't be inclined to do, and make your offer that much more attractive. But the things I was talking about before, know what your marketplace is. Take a look at opportunity areas that you want to be investing in, get your financing in order so you can move really, really quickly. And then, and this is not a sales pitch, but sites like ours, like Realty Track, and there are others who I won't mention today because that would be dumb, but sites like Realty Track give you the opportunity to find those properties before they come to market, because you're going to be able to figure out who's in distress at the earliest stages of that foreclosure cycle. So be doing your homework in advance, whether it's with us or with somebody else.
Yeah, and that's the value add of the teams that we work with at RealWealth, because most of our members are busy, don't have the time to be experts in different markets across the country, but we've got locals who can really dive in and outbeat the iBuyers
Yep.
by through relationships, local relationships. There was a question. There was something you mentioned earlier about certain markets will be affected more than others, and of course that question came up: which markets where might there be more distress? Certainly, if you own property there and you own rentals, people want to know which markets that would be.
So Tupelo, Missouri. That's the one you want to watch. I'm not even sure where that is. So there's a couple things that I can give you as sort of for instances. Look at markets where the local economy is entirely or largely dependent on the industries that have been hit.
Mm-hmm.
So you look at a Las Vegas. The entire economy there is travel, tourism, and entertainment. They're going to take a hit. Orlando, interestingly, you wouldn't think of Orlando as a market like that, but the whole marketplace there, the economic backbone is all travel and tourism. So look at markets like that. Look at markets where you're seeing a trend toward population leaving as opposed to coming in. A lot of this information you can find online. We're in the process of doing a report, and the numbers aren't quite where I need them to be yet, but it will probably be releasing it in January. So hopefully you'll see it in the press. But we're taking a look on a county by county basis at counties where there are investor properties with high LTV ratios, which means you owe a lot of money on the property, that also have high unemployment rates, and where there's a relatively high density of rental properties. So we're looking at all 3,400 and some counties across the country and trying to develop an index of highest risk to lowest risk based on those criteria. And we'll hopefully be publishing that report next month, but I'd be happy to get a copy to you, Kathy, that you can share with your members.
Thank you. Thank you so much. All right, someone asked if this is a good time for a 1031. Certainly, I think if you can sell in a high price market, a hot market, and then get into some of these growing markets, that's what we specialize in, helping you with that.
And do it now before they get rid of the program.
Yeah, exactly. That's a really key point, is the 1031 is at risk. So if you're going to do it now. Okay, do you have 5 more minutes, or do you need to go?
For you, of course.
Okay. Here's a quick one. Mortgage rates probably staying low for a while.
Yeah, people think mortgage rates are tied into the Fed funds rate. They're really not. But the Fed does sort of set the tone, and they've indicated they're not touching rates for at least another year. I would also watch the international markets, because when they're in turmoil, they tend to invest heavily in U.S. Treasuries, which drives Treasury yields down. And if you really want to know what mortgage rates are going to do, follow U.S. Treasury yields. There's actually, if you look at the gap between Treasury yields and 30-year fixed rate loan amounts right now, or loan rates right now, there's actually room for rates to go down further. I don't know that they will, but I don't see rates going up above 3% for at least another 12 to 18 months.
Yeah. Okay, there's a lot of questions on here about which markets and where it might be the best place to get rental properties. I'm going to be answering a lot of that on next week's webinar, so be sure to, if you haven't joined realwealth.com, do it so you can sign up for that webinar. I'm going to answer a lot of the questions we can't get to, but I'm going to really direct the coming questions to you, Rick. There's people asking about commercial storage, mobile home parks. I mean, is that anything Realty Track deals with, or is it mainly single family rental, or I don't know. Do you do
No,
multi?
we get those. We get those. Anything that's in foreclosure, we get. And Adam Data, our parent company, licenses public record data to people that are looking for real estate and mortgage information. So we have access to really pretty much every property in the country, one way or the other. But I mean, the fact is, there are far fewer commercial properties than there are residential properties. There's 120, 130 million housing units across the country, and the number of commercial properties is dwarfed by that. But yeah, we get everything from the storefront to the corporate headquarters. In fact, I just saw that about a month ago, Pier 1 Imports declared bankruptcy probably several months ago, and their stores have been going to market, but the corporate headquarters in Texas just went into foreclosure. So yeah, we do see those as well. And again, I can tell you from my days at auction.com that we sold a lot of limited service hotels, your Hilton Garden Inns, your Marriott Fairfield Inns, to small investors who were highly leveraged when they bought these properties. And I'm not sure they're going to have the financial wherewithal to be able to weather this extended period where the hotels are running at 30 or 40% occupancy rates. So I do expect to see some of those properties coming to market sooner than later. But again, mostly retail, hotel, a little bit of office and multifamily, but the industrial sector is actually coming out ahead because of e-commerce and more cloud computing because of people working from home. So it really depends on the sector you're looking at.
I love that you just said that. There's always opportunity. Whenever there's a challenge, there's opportunity, and entrepreneurs are quick to jump on it. The key is to finding what the problem is and how you can solve it. One of the things that we're looking at right now is acquiring some of those hotels and turning them into affordable housing. You've already got showers, you just need to add a little kitchen in there. So yeah, we're actually currently looking into that model.
I've been kidding people that suburban malls have a really unique opportunity. Because we're seeing those malls turned into multi-use facilities where there's still some shopping, but there's office space now, there's entertainment facilities, and there's even residencies. And so for people of a certain age, whose parents used to say, "Why don't you just live at the mall? You spend all your time there anyway." There might be a chance for me to actually do that.
That's really funny because in downtown, like Salt Lake City and New York, you can live in a condo and downstairs is all the shops. Well, that could be the case with some of these malls. There's lots of opportunity out there. Oh, Rick, it's always such a pleasure to have you here. Thank you so much for sharing your data and information with us.
Thanks for inviting me, Kathy. We'll do it again soon.
Okay, and thank you all for staying for an hour and 10 minutes. I really appreciate it. I'll be on doing a webinar trying to be as interesting as Rick next week, next Thursday at noon as well. You can sign up at realwealth.com. All right, have a really wonderful rest of your holiday week. Happy New Year, everyone. We'll see you in 2021. Yeah. All right, take care. Bye-bye.